You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Mullen and Charles Steinmetz.
Hi, welcome to Questioning Your Sense with Kevin Mullen and Charles Steinmetz. We're back for another installment of Questioning Your Sense today. We've been churning through tax season, and we're excited to be back in the chairs. So we'll go ahead and start today off by with a segue. Charlie, you want to tell me anything special today?
I've been noticing a trend, and I love this trend. So more of the pizza places that I frequent have stuffed crust pizza, and I would love that to be a thing again. Like it's the common denominator, and all the places have this, and so I just think it's fantastic.
So you find your solace in food, huh, Charlie?
No, definitely not. Definitely not. For those who are watching, it's apparent. How about yourself? Anything that you want to tell me about today?
Let's see. I've had about a week now since tax season has we're at the point where we're wrapping up final tax returns.
Sure.
While the tax deadline was extended, the long hours of tax season have reduced a little bit. And so I've got a 12-year-old, a 9-year-old, and a 2-year-old. And love my kids, and so I've been able to spend a little bit of time with them this past weekend, which is nice. My son had a project for school, and so he wrote a little story about his creative dad, and so it was just very nice. My wife made sure to write it up and leave me a copy, and she's very sweet.
That's awesome.
And so that was nice being able to reconnect with my family
after
the really extended hours of tax season.
Right.
So, yeah. All right. Well, today I think what we're going to dive into is talk about your business, whether you're starting a new business or you have an existing business, how it should be set up to generate the most tax benefits and the lowest tax possible. And so we're going to be going through in kind of a comparative format of essentially what the pros and the cons of each of these entity selection types are. When we use the word entity, we're talking specifically about how your business is set up, whether it's treated as you yourself, or it's a taxed entity, or some type of federally or state recognized entity. And so we'll go ahead and jump in. I think we'll attack the low-hanging fruit first.
Sure. So I want to add on to, we did talk about some of these topics before. I would view this more of like a deeper dive in just the entities themselves versus the general business advice. But the low-hanging fruit for me is going to be, so if you're contemplating, I want to do a thing and make money, right? What do I need to do? Well, the easiest thing to do is nothing. Right? You don't have to actually do anything. So an example I give to my clients when we're talking about this, I'm sitting at my desk, I have a little cup there holding pens, and there's a bunch of green pens that are in there. So I grab a fistful of those green pens. If I walk out to the street corner and just start selling pens and make money, I don't have to do anything. I don't have to form a business or make a bank account or anything. I need to declare my income. Sure, if I end up making tens of thousands of dollars off of selling pens, well, my calling was sales, so I should do that instead. But the fact of the matter is, you don't actually have to do anything, and it's easy to do.
Yeah, for sure. Absolutely. So the unpopular advice.
Yes.
The unpopular advice is sometimes you don't necessarily have to do much of anything outside of be compliant, declare your income on your taxes, make sure you're keeping track of your expenses and that kind of stuff. But as Charlie mentioned, we're not going to do a rehash on good business advice. I would go back and listen to our previous episode, and we'll have a reference to that in the description below. But for now, do nothing. Step one. You could potentially do nothing. That's the cheapest.
Selling on Etsy or whatever. You don't have to do anything. Yeah,
it's the cheapest and the easiest way to do business to just make sure you're reporting it correctly on your tax return, but don't set up a formal entity. The second option, also a very easy, very cheap option, is to get a DBA. DBA, doing business as, usually costs you about $35 in order to set up a DBA. A DBA would allow you to request a tax ID number from the IRS and actually set up a bank account. So there's a lot of benefits to having a separate bank account from your personal account for your business. DBA is cheap and it's easy. And that's really the lowest level you can do and still get a bank account for the business itself.
Right. A DBA, one thing important on that one is once you get that DBA, now I have a name of the business. And an easy misconception people will start doing is, oh, well, my business this, my business that. It's not wrong for you to think that way, but it's different when it comes to taxes. A DBA is not a separate entity. It's not a new human you have created. There's other ways to create new humans. In order to get a different business entity, it's a completely separate thing. We'll get into that later. So DBA is an extension of you. It is usually your expenses. This is your income. Do some of these expenses qualify as business expenses? Sure, they do. But the low-hanging fruit on that one, the most common one is, oh, well, my business gave donations to charity. No, you gave donations to charity. And so it's a clear distinction on that one. So DBA is just the name of the business. It's reported on your personal tax return. You're still a sole proprietor, taxed like a self-employed person when it comes to your tax return. And those things will be normal. So whether you do nothing or get the DBA, then when it comes to the taxes, nothing's changed.
Yeah. So I know you jokingly use the word human, setting up another human.
Correct.
I think that for IRC purposes, the Internal Revenue Code talks about it as a taxed person, right? So a tax person is, you can set up another tax person through having entity type businesses. A DBA is not another taxed person. It's just still under you and
that
your
term.
name.
I like that term. I'll use that one.
Yeah, tax person. Human, new human. So DBA is very simple, very easy. You've probably heard of it before. It's a quick way to get into doing business, and you can help yourself by being compliant. While the do nothing strategy may be somewhat viable to just put food on the table, you really do need a business account. Under audit circumstances, the IRS can require that you have a business account. It can be one of the steps that they require in order to be able to file as a business and that kind of stuff.
It looks more like a business.
Yep, absolutely. And you can still reference the business.
Appearances matter.
Yep, but for income tax purposes, it really still is treated as you. We'll get into that a little bit more later. Now, for the lead up, drum roll, please. No, I'm just kidding. So the big one is LLC, and I really can't stand.
I'm going to be interested if we could bookmark this, and I want to compare because Kevin is about to go on a soapbox, and I want to know if it's the exact same soapbox as in the other episode.
It's not going to be.
Probably would be.
It's going to share some similarities. It's not going to be.
I'm not saying in a bad way. I'm just genuinely curious because we do have repeat conversations a lot.
You just know how frustrating it is.
Oh yeah.
So and I will soapbox for a moment. It really bothers me when my clients call me and they just say, "So I set up an LLC." And already, right out the gate, I'm like, "No, you probably did the wrong thing." Immediately, my immediate assumption, and this isn't an assumption born out of malice or ill intent. This is an assumption born out of experience.
Right.
Because so many of my clients will call me and say, "Kevin, I set up an LLC," and I go, "Why?" And they don't know the answer to that. They just don't know the answer. So they set up an LLC because they thought they were supposed to, as opposed to doing it deliberately and intently with
just
correct information. Yeah. And spoiler alert, it's not. That's not what you do. If you call me and you ask me, "Hey Kevin, I'm thinking about setting up an LLC," I love that question. I'm immediately high energy, happy to get your call.
Yep.
I love the chance to be able to explain it to you.
That's what we do. It's
Yep.
the end of every episode.
That's right. I want to give you great
Happy
advice. And instead, when the call is, "Hey, Kevin, I set up an LLC. Now what do I do?" Immediately, I'm like, "Okay, let's figure out how to dig you out of this." Because now the reality is, setting up an LLC is fine, but there are pros and cons. So let's dive into some of those. It's relatively cheap to set up an LLC. If you go through LegalZoom.com, I think it's $430 in total, right? All in with LegalZoom's fees. They don't sponsor our podcast, though they probably should. But outside of that, a competent attorney can help you set up an LLC. Yeah. Usually that's going to run you between $1,000 to $2,000. But still, in the grand scope of setting up a business, that's not that much of a cost if this business is going to profit you more than those amounts over the course of the year, ideally, and certainly over the business lifetime. But yeah. essentially that's not that much of a cost. It's pretty cheap to set up an LLC. What other pros and cons do you see there on an LLC, Charlie?
So LLC is a state level thing, and so it's not a federal designation. You can always, after your LLC, file additional separate paperwork to elect to be a corporation. And I say all those words with intent. There's a reason. Separate, extra, mail in, wait for a response from the IRS. It's not the same thing. So the LLC, similar to the others, a do nothing, a DBA, LLC, generally speaking, is going to be taxed the exact same way when it comes to your tax return.
Yeah, let's use
nothing has yet changed.
Let's use the right phraseology, right? So it's a sole proprietorship. Okay, an LLC. If you do nothing, you are just taxed as you, the person. So sole proprietorship goes on your personal tax return. It may go on a separate form than like your W-2 wages if you're an employee or something like that. But generally speaking, the do nothing is absolutely a sole proprietorship.
Yep.
The DBA is absolutely a sole proprietorship. The LLC is probably a sole proprietorship unless you have taken extra steps or your attorney took extra steps in order to elect to be taxed as a different type of entity. Essentially, one of the first things I do whenever somebody tells me they're thinking of setting up an LLC or that they actually set up the LLC, I always ask the first question is why. That's always my first question. Now, I'm not going to dive into that today, and I'm not going to soapbox on that any more than I have because we've done that in previous episodes. But the second question that I ask outside of why did you set up the LLC is what does LLC stand for? It's one of the first questions that I ask. And the most common response I hear is limited liability corporation. And that's wrong. It's false. It's a limited liability company. You're not a taxed entity like a corporation unless you elect to be taxed like a corporation. And LLC is a limited liability company, and you can have a company without having a corporation. So there's a separation between the two. The important part, though, is not so much the last letter here of corporations, the C. It's the first two, which is the limited liability. So tell us a little bit about the limited liability from an LLC, Charlie.
So what people want with the LLC is they want to protect their personal assets. I set this LLC up and it's just magic in that my business now, anything bad that happens, they can't take my car, they can't take my house. It's just this magic shield. When I go to like movies like Harry Potter kind of movies, like, I got this shield, nothing can penetrate it. It's just beautiful, hunky-dory, and that's what an LLC is supposed to do. Great, that is what it's supposed to do. What we have experienced, whether people tell us or talking to attorneys, spoiler alert, we are not attorneys.
Well,
we're not legal,
yeah, I'll mention.
I'll mention a certain phrase. I like your phrase.
Yeah, so I'll mention that as tax professionals,
Yeah.
we are basically our due diligence requirements are under what's called Circular 230. Circular 230 does allow us to provide incidental legal advice. In that capacity, we're talking a little bit about the legal protections of a limited liability company. We are not attorneys, so please consult with a competent attorney if you have in-depth questions about kind of asset protection. It's hugely important that you get professional advice from a competent attorney. We're just providing some very surface level incidental legal advice.
Correct. And so the legal things, what you need to do stepwise legally to maintain that shield are important. There are times where the legal advice you're going to get, what I tell people, not conflicts, but just makes taxes a little more complicated. And so sometimes when someone says, well, my legal person, whoever that may be, told me to do all of this, I'll pull my hair. I'm like, oh my, this is now what we have to do when it comes to taxes. At the same time, I'm sure that by my telling someone X, Y, or Z, please talk to your legal person pulls out their hair and says, oh my gosh, this is not good for these different things.
Well,
there's a layer of importance that will go on one of those. So what I tell people is, look, one of these has to be more important to you. Can we marry it perfectly? And it's possible.
Yeah.
One of these is going to be more important.
Yeah, just when you ask an attorney, how do I protect myself? For legal purposes, I mean, do you want surface level protection or do you want the strongest airtight, protection that you can possibly get. Because, for example, in a scenario like that, an attorney may recommend that you set up 3 different types of companies, of which some own certain shares of the others. And by crafting it a certain way, you might have really airtight protection. And that might cost you about $5,000 a year to maintain those companies. And all of that is to protect you earning $10,000 a year. Probably not worth it, right? It's probably not worth the $5,000 of legal and professional fees necessary on an annual basis to maintain and keep that protection, as opposed to an umbrella policy of $95 a month. Really solves your problem, and it's deductible. Imagine that. So our advice sometimes can conflict with attorney's advice, not in a legal capacity, because we don't know better than an asset protection attorney
Please look
does.
at these considerations.
Yep. But there are other things to look at. Context matters. Yeah, absolutely. So legal liability for purposes of trying to limit your legal liability, an LLC won't necessarily always do that. For example, in the state of Texas, any LLC solely owned by one party, okay, which for purposes of a community property state like Texas, a married filing joint couple or a married couple for community property purposes is one party. So, one person or a married couple owns an LLC entirely. It's now solely owned, and any attorney worth their salt can do what's called pierce the veil of the corporation. The idea here is an LLC creates a wall between you and your business. And as long as this wall is intact, any
Can you shield set it all with the shield? Now you gotta change the words.
I'm sorry, Charlie.
Be consistent.
We are different people. I'm going to use different words here. This is the way I explain it all the time. So, but you create this wall between you and the business. And when someone wants to sue the business, they can't get through the wall to get to your personal assets. The problem is what you've created is not a wall with the LLC being owned by one party. You've not created a wall. You've created a thin veil. And an attorney can pierce the veil of the corporation very easily. Hard to pierce a wall, easy to pierce a veil, right? So they pierce the veil of the corporation to get to your personal assets. The idea here is that there's insurance products and that kind of stuff to help protect you in those cases. You don't have to create the wall in every case. But if you're earning $10 million a year, it's worth the $5,000 annually to go the complicated route. It just depends, right? There's our it depends counter, right? Maybe that was our first one, which is probably a record. 15 minutes in here, and we made our first it depends. But it really does depend based on the facts and the circumstances.
So if an LLC is bad, it can be good. You follow all the rules, and it should provide the protection that's there. It's just the reality of people's situations. Too often, the rules aren't followed or just aren't in your favor, and it's too easy for them to just move the veil. Hey, I'm touching you anyway. Gotcha.
Pierce it, get your personal assets, and that's no good. So if your goal is to set up the LLC to protect yourself legally, you may not be doing everything that you need to in order to protect yourself. And so that's one area that I see. I saw a poll from the state of Texas, and it was, I don't know, it was probably 6 or 7 years ago. It was a while ago. But they found that the number one reason people set up an LLC is because a friend or a coworker, a neighbor advised them to. Basically, someone they trust told them that they should set it up. That's the number one reason. Not a tax advisor, but a friend or a coworker or a neighbor told them that they should do it.
Or a legal person.
Yeah, I'm like, what? So I see a tremendous amount of LLCs set up when an LLC was not necessary. That's why I'm a little jaded when it comes to that phone call of, so I set up an LLC. That one, it bothers me. I'm thinking of setting up an LLC. I love that question because it gives me the opportunity to advise them prior to them having the fees and signing up, because now the state of Texas, you're on their radar. You're, at least in Texas, you're required to now file at least a no tax due report every single year.
Right. That was my next point, was just the LLC is that kind of that first graduation in business. If you're starting from, the nothing to the DBA to the LLC, it's the first thing where you have now more paperwork than just your tax return. You're not filing additional paperwork, the state stuff.
Yeah.
Texas has one. I can't say every state LLC has that they have to do, but we deal with Texas rules where we live here.
It's going to
so it's
depend
more
on the state's
paperwork.
rules. Yeah,
Correct.
absolutely.
Yeah. And so it's the first one you have now got extra paperwork you got to deal with.
Yep,
which
and
is-
that alone scares some people off of setting up an LLC.
Right.
Some people just don't want that extra step, that one step.
Right.
And I am going to blend a little bit of what we talked about last time, simply to say that setting up a business requires you to be good at business. And if that scares you away from setting up an LLC, you probably don't have any business actually running a business,
Right.
because there should be administrative efforts taken to make sure that your business is compliant, and that should be assumed. But anyways, I think that mostly covers us on LLCs. Any other thoughts?
No, I think we've
Okay.
defined the horse well. I didn't beat the horse. We've defined the horse well.
We
It's a pretty horse.
lightly prodded it.
Yes.
Okay, so let's move on then. Before we do that, though, let's make it very clear that there is a difference between the way that do nothing, right? Number one, do nothing. Number two, DBA. Number three, LLC tax as a sole proprietor. There's a really big difference and a separation here between that and our next couple of options here. There's a definition here of sole proprietor, of which I think we've mostly covered.
Yep.
Sole proprietor means it's taxed as you, the person. And then what's called a pass-through entity. The next two options that we discuss will be pass-through entities. So let me give you a little bit of an explanation of what the pass-through entity is. Essentially, they are not a taxed entity. Rather, after recognizing and reporting their income and expenses to arrive at a profit figure, that profit passes through to the owners and is reported on a tax form. It's called a Schedule K1, but it's reported on a form. Think kind of like a W-2, though more complicated, for you to report on your personal return, which means if I own a business and that business at the end of the year has $20,000 of profit, then my business does not report $20,000 of profit as taxable income.
Right.
It reports $20,000 of profit and passes through that $20,000 of profit to me, Kevin Mullen, and I then report on my tax return the $20,000 of profit.
Correct.
So really important that you understand. A lot of people say things like corporations don't pay taxes. Okay, and I know I soapboxed about that before because I remember, but I will say that S corporations and partnerships, of which we're about to go into, do not pay taxes because they are pass-through entities. They are literally designed not to pay tax.
Right.
Rather, it passes through their tax implications to the owners.
The tax is still being paid. It's
Yep.
just by
Yep.
somebody else,
Not by the company.
business.
Yep,
Correct.
yep,
Company.
precisely. So knowing that, let's dive in.
Well, in conjunction with that, I think it's important because this matters to both of them. The amount of tax-exempt income that you're required to report is not always equal to, the income you pull out of it. So your business that made $20,000, you decide to leave all $20,000 in the business to then further your business. The business still had $20,000 of profit, and Kevin will still pay tax on $20,000. So whether the money leaves the business account and goes to a personal account or not actually doesn't matter. What matters is how much income, how much profit did the business actually have. That matters for both the partnership and the S corp. That's that pass through, and it's sometimes a not difficult concept, but just a foreign concept of it breaks my logic. I didn't take the money. Why am I paying the tax? That's how it works.
Yeah,
That's how it
it's
works.
probably one of the most misunderstood concepts of a pass-through entity.
Right.
Because in the scenario of which I had $20,000, but I took $30,000 out of the business, I only pay taxes on the $20,000, right? And there are ways for that to happen with accelerated depreciation and deductions and mileage and that kind of stuff. There's several ways for me to be able to
Or just seed money. I put this much in.
Yep.
Take this out.
only report the $20,000 or only report to the IRS that I earned $20,000, even though I took out $30,000.
Correct.
Yeah, absolutely. Also, it can be very difficult for things like partnerships, which we will dive into next. But essentially, you can have a distributive share passed through to the individual. So if you and I are partners,
Correct.
and instead of $20,000 of profit that gets reported on my tax return, We now share that $20,000. So your distributive share at 50% is $10,000. My distributive share at 50% is $10,000. And by us both reporting $10,000, we've met the $20,000.
You went too fast. Let's do a hitch. 90-10. 90-10.
Oh gosh, Charlie. You and your movie quotes.
Of course.
Okay. But the 50% and 50%, 10,000 and 10,000. Except in this scenario, Charlie took out $15,000 from the partnership, and I took out $5,000 from the partnership. So but the K1, and that can get complicated. So I shouldn't go too in depth. But again, suffice it to say, what is reported on this K1 from pass-through entities is your distributive share, not the reality of what happened with your bank account in regards to the business.
Correct.
It's the thing that most people don't understand, even after I spend 30 minutes explaining it. So anyways, okay. So let's dive into the partnership before we rabbit trail too much into distributive share.
Other things.
And let's talk about what the partnership is. So partnership inherently can either be set up through an LLC or directly with the feds.
Right.
But a partnership generally exists when two or more people share in income and expense.
Other than your spouse.
Yep, other than your spouse. So I know you're going to talk about that a little bit. But essentially, it is required if you share an income and expense, period. The one exception here is the spouse.
Correct.
And there are a few other exceptions, but in general,
Correct.
If you share in income and expense with someone else, that constitutes a partnership. So I have had a ton of people stumble into a partnership on accident.
Right.
And it's really not what they wanted when I start to tell them what their requirements are and the extra reporting and all this other stuff. And they didn't necessarily keep track of everything the way they should have. And they just thought it was a great idea to have a partner.
You can set up a partnership. Absolutely. Walk into it eyes wide open.
That's right.
But this is something where, as Kevin was just saying, to stumble in. I mean, my do nothing example, if you remember my stack of green pens, let's say my best friend here goes, "Hey man, you're making $10,000.
I want in a piece of that action."
Absolutely. And so we go in together, and now we're just making money together on this whole deal. We'll go over the things. We didn't do all the things to intentionally set up our partnership. And then I go tell my tax person that, I do my taxes, but hypothetically, my hypothetical tax person that, oh yeah, me and my best friend did all this. I was doing my own, then I did this. And but here's my part. And my tax guy is going to have words with me. Say,
absolutely not. That's not how this works.
Correct.
It's more complicated, and you have forced my hand or your own hand.
Your own hand. So it can just happen.
Yep.
Let's exclude that part and talk about the intentional. If you're doing this and doing it right, this is the right way.
Yep.
This is the
So probably the most common way of setting up a partnership is if you set up an LLC. If you set up an LLC, generally speaking, the federal government wants to tax you like a partnership in many cases. I will say that Ward Mullen, one of the two founders of Mullen and Associates, and the primary genius behind our tax strategies, Ward Mullen, who I sometimes affectionately refer to as Dad, has said many times over the years that a partnership is the worst way to do business. Now, what you heard probably was it's a bad way to do business, and that's not what I said. What I said is it's the worst way to do business. Meaning you have many options available to you that we're going through today. The reality here is that of the options available to you, a partnership is usually the worst way to do business. Right. It has a lot of flexibility that some of the other entities don't have. And that's the only real pro compared to some of these other entities. It can be cheaper to get going. It can be cheaper to maintain. It can require less of your attention. And it just is bringing on additional partners and exiting partners can be more convenient. It can be easier. And so the partnership has a lot of flexibility. But I just want to illustrate one thing for you. Imagine for a moment that you and your partner are standing side by side and you're about to walk 500 miles and then you might walk 500 more. Okay.
I got
But
a song on there.
yeah, sorry, I couldn't help it. So you're gonna walk 500 miles, and your partner's standing right next to you,
Yep.
but there's no road. You're just walking, and you and your partner start facing east. Generally, you are just facing eastern, but they are off 1/100th of a degree, barely. They are barely facing a different direction than you, and your partner walk 500 miles.
You walk side by side for a long time.
Yep, but
You really will.
eventually you will not even be able to see each other, right? You are so far away, you will not be able to see each other. This is what happens in partnerships. A vast majority of partnerships end unpleasantly. A really large majority of them that I deal with, and so. So what happens is you initially start with the same vision and the same thoughts in mind, or at least what you think is the same general vision. But what ends up is you guys are so far apart in what you want from the partnership, or what you think the right direction of the partnership is.
Right.
And so it's important to have a lot of this stuff set up initially.
So that setup initially is called a partnership agreement. You really want a very solid, well-written partnership agreement. Even if, in the case of two friends, I'm pointing at my buddy here, getting into business selling green pens on the side of the street, we really should have a partnership agreement in force. At some point in time, we're going to have a difference in opinion. It happens every day.
Every single day.
We will have a difference in opinion about how to move forward, what is best in X scenario. So having the right formation of how we set stuff up, how stuff is split during the time that we're in business, and what each individual exit strategy is, are some key components to have in that partnership agreement. I'm sure there are plenty of those in the legal field who have a lot of just kind of prefabbed, here is the generic stuff you do. We just kind of modify a couple of things and then call it good. Maybe, but having a solid partnership agreement is important. It also, there are things that you can construct in that partnership agreement that allows that flexibility in the taxes of, well, we're going to do things differently because of this. Hey, if that's explicitly written and agreed to upon by both parties, we have that flexibility. If it's not explicitly written and agreed to by both parties, we probably don't have that flexibility to just go, oh yeah, sure, you agreed on that 12 months ago, and clearly that's totally fine. I can't do that. And so partnership agreement is important to have those things ready.
And my mother always taught me growing up, frustrations only come from unrealized expectations. And you are, the better this document is, and the setup of all of this is, of what the expectations are, the less room there is for frustration in the future. So I'll speak to kind of one of the other points that is can be a pretty big con with handling things through a partnership, is that in many cases, the income received from a partnership is going to be taxed at a self-employment tax rate.
Point, and you just
Yep.
that was perfect
because we're on the wavelength. But yeah, so the self-employment tax essentially is the employee taxes that you pay through your employer. So 7.5% of your income in Social Security and Medicare tax, except you're now self-employed, right? And so you through your own partnership,
right.
You don't have an employer who's taking 7.5% of your wages from you and paying it to the government, and then matching that contribution where they pay the other 7.5%, the total 15% employee taxes that they pay on your behalf. That's not happening here. What's happening is you are accountable to pay both halves. So you're paying 15% extra essentially in taxes on some of the earnings that you're drawing from the partnership has. That's a lot of tax. That's a lot of extra tax. That's not even counting your income tax. So if you're in a 22% tax bracket, you may be paying 37 cents on the dollar in taxes on partnership income, depending on the nature of the income.
Sounds like a high number. It also means that deductions are very strong too, because the deduction offsets the tax it would have. So if you have $1,000 deduction, it offsets $370 of tax. It does not offset $1,000 of tax. I know we talked about that at least once before in our podcast.
Yep.
Please don't ever be under the assumption that $1,000 write-off equals $1,000 less I pay in tax. That would be lovely, but it's not the case. And
in most cases.
In most cases.
It depends, Charlie. The answer is always it depends.
It depends. It could be. I don't know one-to-one. But I have one more point. I have an important point. I can't think of the important point right now.
I think we've got it covered at this point. I think
Good enough.
if something else comes up, we can mention it because we're still in this kind of pass-through entity
Yes.
discussion. Remember, we talked
Yes.
about the first three: do nothing, DBA, and LLC are all generally sole proprietorships, and now we're moving on to the pass-through entities. So partnership being the first, and we'll dive into the second, which is S corporation. So an S election or an S corporation usually comes from setting up an LLC initially and then filing a Form 2553 to elect to become an S corporation. That's generally the way that you would set up an S corporation,
Right.
though there are other ways that you can do it directly federally. The S corporation is definitely different than the partnership. Number one, instead of being a percentage ownership partner, instead an S corporation is dealt with through shareholders rather than partners. So the amount of shares that your S corporation has can vary. You can determine that amount. It's very common for an S corporation to have 1,000 shares,
Right.
and then you have owners within that S corporation.
Most people end up dealing with it in essentially the same way, right?
Yeah.
I own 300 shares, you own 700 shares, it's 70-30,
Yeah.
and it essentially operates the same way. It's just the terminology is different, and you will see different things when you're looking at your forms.
Yep, absolutely. There are additional administrative requirements through
Yes.
setting up an S corporation. Now we start getting into some of the kind of the higher tax savings. Now the federal government starts requiring you to do more things, meeting at least once a year, and recording those minutes and
Right.
having those types of shareholder meetings.
You really are acting like a business, like a watch TV. This is a business. Yes, lots. My phrase, I even wrote it down. Lots mo paperwork. I tell everybody, you want to do this? There's just more things involved. Kind of mentioning the administrative costs. So it's just not in a way to put you off, but more in a way of, again, walking in eyes wide open.
Yeah.
So it's just be aware these are things that will be required of you. You want these things to be required of you because,
That's right.
again,
Does it excite you? Right? Does it get you excited that you have a business to run?
Right.
If the answer to that is no, then you probably do not belong in business ownership. You probably ought to work for a company that allows you to exercise your passions. But if running a business is exciting to you, growing, expanding, hiring, maintaining, handling the administrative aspect of the business, if that excites you, then you absolutely have that entrepreneurial blood in you, and you should
Right.
take a stab at it. The American dream here.
Not to say that, so that would be just kind of from go. I would absolutely agree with that. There are, and then we'll get to it. We want to talk about a couple of things first, I think, but there is a point where we react to questions. I would like to answer those things, but there are times where the numbers, the facts merit what I call unsolicited advice. This is now so strong, I'm going to tell you, even though you didn't ask me about it.
Yeah.
So an S corp, once your profit hits a certain level, it may be worth, even if you don't like all of those things, the reasons to do it from a numbers only perspective may be strong enough to go, maybe it's worth all this extra headache and heartache.
Yeah. So the part of the way that I explain this is there comes a point at which you will agree to take on this headache. Right? Is that point $1,000 in savings? Is that point $10,000 in savings? Is that point $30,000? Like, where's the point? Because if I tell someone that I can save them $30,000 in taxes, they will say, "Okay, Kevin, tell me what I need to do."
Right.
You need to do these things, and it's going to take you about an extra 50 hours a year of your life in order to do those things. And they say $30,000, 50 hours, absolutely worth it. Kevin, sign me up.
Yep.
Right. So, but everybody has a different threshold, because I might tell someone that it saves them $1,000. They might say, "Yep, I'm in."
Mm-hmm.
And I think, "You sure?" "Yep, absolutely." "All right, great. Then here's everything that we got to set up."
Right.
Right. Because essentially that person that saves $1,000 now, maybe they have a growth mindset.
Sure.
And $1,000 next year is easily $3,000 that it saves them.
Get it
And the
now.
next year, 8,000. Right. And so, yeah, absolutely.
So some of the things, one of them is an S corp, you need to pay yourself a commensurate wage. The commensurate is a flexible number. Talk with your tax advisor. It's a very important thing. I'm not going to say X or Y here, but it needs to be a number, right? With paying yourself a wage comes, as Kevin was explaining, with the self-employment tax, the employer and the employee side of FICA taxes, so Social Security and Medicare, you now have to send those quarterly. We had a different podcast. I mentioned there are lots of different quarterlies out there. This is just one of them, but you have to at least every few months now you're sending them the Social Security Medicare you took out of your wages. So that's, more paperwork. You're doing this, you're doing this, right? You've got the tax return itself. So the pass-through entity is not filed in your personal tax return. You're not now paying for and filing two different tax returns.
And to be fair, just to clarify, the partnership also is that way.
Yes.
Right? So as a pass-through entity, they are taxed entities and have their own reporting requirements. I just wanted to clarify that.
Absolutely.
To interrupt you.
So you're filing two tax returns. So it's carrying now, I'm doing this during the year, I'm doing this every quarter, I'm doing this at the end of the year, I'm doing this to now with my personal taxes. I got to do this one first before I can finish my personal taxes because it's going to flow through into it. There are things involved in that. At a minute, kind of a low-hanging, this is an easy one. If you're doing certain types of business, your state may also require like state sales tax you have to send them and different things involved.
Oh yeah, to be fair, state sales tax can start from go.
From
the nothing.
Yep.
You can start
Selling
having state
pens,
requirements.
it's a
That's right. That's
product, have to retail.
Yep, absolutely. So the S corporation is really where some of the meatier tax saving strategies start coming into play. More things that can be deducted, things that can be owned by the business, and manipulating how much you're paying yourself on a W-2 in order to unlock certain deductions,
Right.
and that kind of stuff.
Sometimes you want it low, sometimes you want it high.
That's right.
Actually.
That's right. Now, starting
Correct.
in 2017 with the implementation of the qualified business income deduction,
Right.
we'll colloquially refer to it as QBI. So for qualified business income deduction, or QBI, is unlocked based on certain factors and limited based on certain income levels.
Right.
The higher your income is, the more your QBI deduction is limited. That deduction can be unlocked by paying yourself a greater wage.
Right.
I've got examples of clients who do this and save between $5,000 a year to $80,000 a year. And I'm not talking about just saving that much in their income. I'm saying that much in tax. It can be really, really tremendous, making sure that you are paying yourself the right amount of wage. Now, real quick though, talking about the commensurate wage, it actually is only required if you are an operator in your business as well as an owner, right? Because if you just own the business and you don't work and provide services in the business, you are not required by law to receive a commensurate wage. It's just that most people who own an S corporation are also working within it. And assuming that is the case, you are required by law to pay yourself something. And so now what commensurate is for what you provide is where the flexibility comes into play. But there's a lot going on with an S corporation, a lot more to file. I find that as I advise folks to save the dollars and set up the S corporation, it's very, very common that they become overwhelmed with the amount of things that they have to do, because they really just were looking for the tax savings and not necessarily for the administrative headaches. And so it is important to note that setting up an S corporation really means that you want to be owning and operating a business.
You can offload those administrative headaches, and that's not what our goal is, to tell someone, hey, great, now you're making this much money, you should pay us more fees. That's not our goal.
But if we're saving you enough money, you should.
Right. Where's the threshold? There's that magic threshold.
That's
It is still sufficient even with this considered. And so to give real numbers to it, because we need to actually, I think in this podcast, talk about that. So let's say one magic number, what we've been using for years, is around $50,000 of profit. So after all your expenses is done, let's say I was selling my green pens and I made $50,000 of profit.
So how much revenue in that hypothetical example, Charlie?
So I had $70,000 of revenue. I had $20,000 in expenses.
Right.
And so I have $50,000 of profit. I will pay tax on that 50 grand. I do that very first year. Kevin and I were not in partnership at that point. And my tax guy tells me, great, you're paying the tax plus self-employment tax and XYZ. But if you were to now, form an S Corp and then go forward in the S Corp, let's say, based on the factors and discussion we had, we decide that my commensurate wage should be $20,000 for the year. Great. That $20,000, we're getting a little technical, but I have to do this to paint the picture. That $20,000, essentially, I'm still paying the self-employment tax. I'm still paying it out of my wage, and the company still has to match it.
Or the
15%.
employee tax.
Correct.
Right? You as the Charlie person
Yes.
is paying 7.5%, and then the Green Pen S Corporation is paying 7.5%.
Which I'm 100%, which I then pay anyway.
Yep. So
Correct.
15% employee tax. So no self-employment tax, but he is paying the employee tax in that
So
hypothetical.
I'm paying essentially the same tax on that 20 grand.
Yep.
But the 30,000, the other portion of my 50, right? I pay 20 as a wage. The other $30,000, that is now part of the pass through to me on my personal tax return, is ordinary business income with no self-employment tax.
Mm-hmm.
It's ordinary income, and so the 15% of that $4,500, I have now less in tax. I have to write Uncle Sam a check. It's less than last year, $4,500 less than it was the year before. Hey, so yes, paying for a tax return. I'm going to pay him to file the W-2, to do the 941s, to do this other kind of stuff. Maybe that costs me an extra $2,000 total in the year, but I still net save out of that deal. Is it sufficient enough, right?
Yeah.
Where's the line?
Yeah, exactly. What are you willing to put up with?
Correct.
What are you willing to spend more of your time doing?
Correct.
In order
Time
to save
or
that money?
but
Yeah,
yes.
absolutely. Because there's a threshold for everybody, and that threshold is subjective, not objective.
Correct.
Objectively, if it saves you $1, you should do it. But the reality is, there's a time value of money.
Right.
Yep.
Right.
Yep.
And so that's where the unsolicited advice comes in. So it's a certain point when they unsolicitedly just tell you, hey, you really need to consider doing this thing for all these different reasons. S Corp being that one of, please, let's look into this. It may be really worth your time.
Yeah. There's also a layer of legitimacy to setting up an S corporation. Because you're really telling the federal government, I am a business. I'm willing to go through all of the hoops, jump through all of the hoops in order to make sure that I can still classify and qualify as a business.
Mm-hmm.
And then for purposes of audit and that kind of stuff, what is reasonable on a do nothing and what is reasonable on an S corporation are very, very different. And so you can get away with more write-offs that may appear unreasonable under some of the other strategies by having an S corporation set up. So it costs you more, it's more time, it's some of these other headaches, but there are real benefits to having it set up.
Yeah.
Now, the S corporation does have its own limiting factors. For example, an S corporation cannot have more than 100 shareholders.
Right.
So now we're outside of the realm of small business, and here we're really diving into more $10 million of revenue plus a year type of business. Now, we're not going to spend a tremendous amount of time in this area, but there comes a point at which you want to transition out of what's called a pass-through entity, like the partnership and the S corporation. So remember, do nothing, DBA, and LLC are generally sole proprietorships. The pass-through entities are partnership and S corporation. But now we're actually going to jump into a taxed entity, what you might call a corporation, or what really is referred to as a C corp, a C corporation. A C corporation is a taxed entity. The corporate tax rate currently sits at 21%. President Biden currently is trying to create legislation for C corporations, to be taxed at 28%. Now, there's a lot of intricacies here. Again, we're not going to dive into a lot of the minutia, but let's give them some surface level points.
So a C Corp is new human. What's my new word? My new phrase?
A tax person.
A tax person is a little legitimate.
Oh, Charlie. Legitimate.
Is an actual separate real thing. It pays taxes. It owns its own assets, everything. So at the same time, you transfer assets into the C corporation. The partnership, the S corp, really, you need to create a good separation there, but the C corp is a hard separation. You don't own this anymore. The corporation owns this.
You don't own the assets. You still own
assets,
the
correct.
corporation.
Correct.
Yeah.
Yes. And so there's a hard separation there with that, the corporate thing. So the lines are very clearly defined and need to stay clearly defined in the C corp type world as a separate entity, right? And so there's important distinction with that one.
There's a really tremendous amount of administrative work necessary with the C Corp. Essentially everything that the S Corp has to do, the C Corp has to do, and then some. And so there's
Everything you can do, I can do better. New song.
Anyways, and so the C corporation itself has a lot of administrative requirements, a lot of paperwork, a lot of stuff that you have to do, a lot of hoops you have to jump through, and so it really is only attractive under certain circumstances. Now, for income tax purposes, the interesting thing here is because the tax rate currently on corporations, C corporations, is 21%. A very common tax bracket for income tax purposes is 22%. And so there's a lot of scenarios in which you like the corporation paying taxes as opposed to you as a person paying taxes,
Right.
if the profits, revenue and profits are high enough under the C corporation.
The challenge is that C corporations often end up in a double tax situation, right? Not for
Often,
corporation, but
usually they're structured not to be taxed twice.
right.
But if you want to take money out of your C corporation,
Right.
it's taxable to you as a dividend. So the downside here is the corporation pays taxes on the profit and does not get to deduct the dividend that it pays you, which means that you pay taxes as a person for having received the dividend, and the C corporation pays taxes on the profits that it recognizes. And so it is very possible that you would pay taxes twice if you are receiving money from the C corporation
Right.
as a dividend.
The challenging thing for us to speak too much on the C Corp is really get into the C Corp world, and it ends up being it's the same world for you running a $2 million business and Exxon, right? Exxon,
They had a little over $2 million in revenue last year, didn't they?
well, I have no idea. I mean, I don't know the gross revenue.
I didn't say profit, Charlie. I said revenue.
Yeah. So I happen to know, you do too, but and tax exec at Exxon who worked for them for a long time, and whole department, whole floor. They had 7 IRS agents full-time working in their floor year round. They are filing their tax return daily. Can I sit here and just spout off, here are the different pros and cons and ins and outs of C Corp rules? Clearly not. It just can't happen. There is an enormous range of things there. So as Kevin talked at the beginning of, just that we're not going to go too deep into it because we'd literally be here all day, every day for the rest of the year, just talking about different things that can be there. But on a general sense, this is what we got today.
Absolutely. The C corporation theoretically has the highest tax savings, the absolute highest, because the corporate tax rate is capped at a lower range than the individual income tax rate. The income tax rate for an individual is the income tax, at least, is 37%, right? So that's where it caps out at, is 37%. There are additional taxes that you can be levied, but suffice it to say that the individual income tax cap is 37% currently. And so that being said, that's a much higher rate than the corporate tax at 21%. So the C Corp tax rate and the tax savings that you can get there are theoretically the absolute highest that you can get. You just need the income and expenses necessary to generate that benefit.
Right. C Corp can have more not flexibility, but it can do more things. It can own more things. It can have more types of expenses that others couldn't have because it's its own tax
not very flexible at all.
Right.
But
rigid within the rules,
for
just
purposes
more
of
options.
what you can benefit from, it's very, very high. And so that kind of gives us our groupings here of our sole proprietorships, our pass-through entities, and our taxed entity. Now, there are more intricacies here that we haven't gone over, like PLLCs, right? So a professional limited liability company. and those types of things. MLPs, right? A whole lot of different things that can come into play in regards to partnerships, which can be very complicated, like publicly traded partnerships that you'll find, in investing through, your broker and that kind of stuff. But we're not going to dive into all of that. If you have questions, please let us know. We would love to hear them. We love to take questions all the time. That's our favorite thing to do in our job. It's where we are the most comfortable. Prior to our final segment here, what I do want to mention is that there are quite a few things that are important points for you to know if they impact you this year in 2021. If you have, dependent children or had received any type of unemployment compensation this past year, if those types of things, we've got 4 different, about 5.5 to 6 minute videos that we will include in the description below. Please check those out. It's really important that you understand, just at a very shallow surface level, some of the oddities that have come around this year. We did a couple of webinars last year in regards to the payroll protection loans and that kind of stuff. Those were some oddities then. These, at least to get your toe dipped into the water, please listen to these videos. They will probably cause you to have other questions. Please reach out to us. We love to answer questions in that capacity. We'll go ahead and switch over to the comfort zone. Clark, do you have any questions for us today?
So I've got 2 questions for you today. The first one is, I inherited a home. I'm now selling it. How do I treat this for tax purposes?
So I like that you separated inherited the home versus I have inheritance in general.
Yeah. So we get this question all the time.
Yes.
This is probably in my top 10 of questions that I get from my clients. So I'm sure you deal with it a tremendous amount.
Not that everybody's dying left and right, but it's of the important questions that people remember. I need to ask my tax person.
Yeah, this is very common.
Yes.
So, all right, let's dive into a couple of. Clark, we may not even have time for 2. It may just be this one, because this one is quite lengthy. So first and foremost, the date of your loved one's passing matters a lot.
Yes.
That date, you need to know the value of the home on that date. Now, to ask a clarifying question, is this just one person who was the sole inheritor of the home, or were there multiple inheritors of the home?
Let's go with both situations. Let's make it a really good question.
Okay, so let's just tackle the first one.
Sure.
And let's assume that you are the sole inheritor of the home. The value of the home upon the date of your loved one's death is a number that we need. Essentially, there's something called the unlimited step up in basis, which allows you to create a cost basis at the time that they pass. Whatever the value was at the time that they passed, it's a tax break or a tax benefit. A lot of times, if this person's will went through probate, the probate court may determine the value of the home at the time of their passing. Sometimes that happens. Sometimes you have to go off the tax rolls. My recommendation is you pay to have it appraised as soon after their death as you can, because the value of the home on the date of their passing matters a lot.
It's never on someone's mind to have that done at
That's
the
right.
time, but
if they call it ask, I tell them.
Yes, that would be the thing. Absolutely. So to clarify, I say it differently. So maybe we say it in 2 different ways to make sure we're syncing it incorrect.
Yeah.
So inheritance, there's different pieces. I also have to say, hey, was it cash? Was it life insurance? Was it house? Great. It was a house. There is a portion of that is tax-free. The whole thing is not taxable to you. The tax-free portion, the inheritance that you get, you're never paying tax on, is exactly what Kevin was saying. The value of the home, the date that person passed away. So they bought it for $100,000. It was worth $200,000 when they passed away. The $200,000 you're not paying tax on, right? Now, the time between them passing and you selling that house, as we have all seen in real estate, things change. And that change you own tax-wise, whether it's up or down. Generally it's up, good problems, but generally it's up. And so let's say you decide to hold on to it for 2 years, clean everything out, fix stuff up, etc. And so all of a sudden it was worth $200,000 when they passed away, and now it's $240,000. Taking out you get to pick up the improvements and the closing costs, etc. Just make it real easy. The 200,000 was tax free. The 240 was what you sold it for. $40,000 is what you would have reported as the gross income from that. Again, we can take expenses stuff against that, but the 40,000 is what is taxable to you in that case.
Yep, absolutely. It's taxed at a long-term capital gain tax rate, even if you held it for less than 1 year, which would generally indicate that it's a short-term gain taxed at a higher rate. But you get the benefit because it's an inherited property. You get the benefit of a long-term capital gain tax rate, period. In the example that Charlie gave, where it was worth $200,000, but you put in $15,000 into the property, and you had $10,000 of closing costs.
Right.
In that scenario, your basis goes from $200,000 to $215,000 because you put in $50,000. And your top end of $240 goes down to $230 because you had $10,000 of closing costs. So now your basis is $215,000, and your sale price essentially is $230,000. So instead of paying taxes on $40,000 of gain, you pay taxes on the difference between the $230 and the $215, which is $15,000.
Correct.
So there can be a lot involved in that. There can be even more than that. Now, for purposes of that exact scenario, but there are two inheritors. Okay, so you have a sibling that also inherited the 50% share of the home. Now it depends who put money into the home. Let's assume that you split that 50-50. So, you put in $7,500, your spouse put in $7,500, and that's the $15,000. Well, then in the scenario of you have $15,000 of profit, it just so happens that you each have $7,500 of gain in that scenario because the $15,000 of profit is cut in half, and you each report that share. Now, sometimes the estate itself sells the home, and you receive the proceeds. That can be more complicated because it's very unusual, but sometimes it happens. If the estate sells the home, then the estate recognizes the sale itself, of which it can pass through the ramifications to you as an individual or pay tax itself. The estate tax rate is 35%. And so that gets into kind of some complicated stuff outside of the comfort zone.
The other one is the multi-owners. So the multi-owner one, you're talking, start with the two. To me, what seems to happen is it happens one of two ways. If the title company has all the relevant information up front, they can do it well. Each beneficiary gets a tax form for their portion. It sells for $200,000, and so it was Kevin is my brother in this scenario, therefore we each get part of the house. He gets a tax form showing $100,000. I get a tax form for $100,000. We each report our portion of everything and come down to that $7,500 each as taxes. That makes it easy. What makes it difficult is when Kevin is the executor, the title company doesn't have all the information, and just Kevin gives me my portion of how much he got out of that whole sale. Now, how do we deal with this? Because the tax form all went to Kevin. So he's got that tax form that goes on his tax return, and nothing came to my tax return.
Wait, let's not make it rhetorical, because you actually asked a rhetorical question there. Now, how do we deal with it? It's easy. Pick up the phone, call us.
Yeah.
Because we'll guide you through it, and you don't have to deal with this mess.
Correct.
So we don't want to get into too much minutia here. Essentially what you can see is that it can be very complicated, right? It can be very difficult to deal with this situation, but it doesn't have to be. You just need the guidance of a competent tax advisor, and we can advise you on how to handle this.
Right.
One of my favorite things is when I have a client who is the executor who asks me this question. Mm-hmm. And then I can advise them and make sure that they have all the information that they need to provide to the other inheritors.
Right.
What's very frustrating is when my client is just one of the inheritors and not the executor. And the executor doesn't have someone like me advising them. That is frustrating to no end, because I will tell my client that they need certain things that then they ask the executor for, and the executor doesn't know what those things are. And it's so frustrating. So it's complicated. If you're an executor of a will, you need to make sure you're making good choices with this kind of stuff and that you have professional direction. So reach out to us.
But essentially, the root is this is the piece that's taxable.
Yep, absolutely. You have to eventually determine what is taxable and only report that.
Correct.
So that's the quickest we can come up with. Not very quick.
That was good. I think this next one will be even quicker. So we'll see if we can get it in. Second question is, why is my tax refund being delayed?
Okay. So essentially, there are a couple of things that could cause this. Maybe we'll grab the 3 lowest hanging fruit, and then Charlie, if you can think of something else, let me know. But the first one this year, which is new, if you received a stimulus payment and did not report correctly what you received on your tax return, not as income, but informationally, then you may have calculated what's called a recovery rebate credit on your tax return. And the IRS may not agree with you because they think that you reported it incorrectly.
Right. I got 1,000. I should have got 1,200. Therefore, I put that on my tax return. My refund goes up by 200 because I should have had 12, and send that off. And the IRS goes, "Man, I gave you 1,200. What are you doing?"
Yep, exactly. So, whoops. It's just an oopsie. I put 1,000. I meant 1,200. You don't want to get that wrong.
Right.
So I have had plenty of people this year who may have reported the incorrect amounts or too flippantly said, "Oh, I got X," right, and they weren't 100% sure, and so now their refund is delayed. It can be because the IRS attempted to deposit your refund into your bank account, but the bank account number was wrong, or for whatever reason the bank was unable to accept the wire, and so it goes back as undeliverable to the IRS. They will then just turn around and mail you a paper check to the address that you put on the tax return.
Right.
And then third, I will see every once in a while. I haven't seen this lately, but third is if your refund is over $10,000. Sometimes the IRS just mails you a check as opposed to direct depositing it. Can't figure out rhyme or reason why. It just has been our experience that if your refund is over $10,000, every once in a while they will mail it instead of direct depositing it. I guess we'll add a fourth one, and that has to do with if you have outstanding money that you owe to the IRS from a previous tax return. They won't send you the refund in many cases. They will zap it and apply it to what you owe.
Right.
Now, if there's overage on your refund, then they'll send you the remaining amount. You'll also get a letter that says, "Hey, we took this much of your refund to apply it to an amount that you owe from before." Or if you owe far more than what your refund is, they'll just take your refund and apply it. Sometimes they'll let it through, but by and large, it'll be zapped.
So at this stage, I agree with all of those points. If someone's listening to this at a different stage in the year, there's one other thing that can be delayed, and that is if you have like those that want to try to file like late or early, even January, because they have a lot of kids, they qualify for earned income credit. There are a couple of pieces in that where the IRS a couple of years ago forced in delays. So if you have any of these key things in your tax return that you're getting extra money more than you paid in, big refunds, you're not getting a refund. They're not even processing your tax return until February 15th. It's not going to happen. And so that could be a delay as well.
Yeah. And for what it's worth, the reason why that's the case is because those are the easiest areas to commit tax fraud.
Yeah.
It was 2016, 2015. I think it was 2015 was, I believe it was 2015, if I remember right, was the really big year of tax fraud. There was $40 billion with the B, $40 billion of government money that was sent out to just a handful of people who were committing tax fraud. It was a really crazy event that caused the IRS to change quite a few things in the way that they operate. And frankly, I don't give the IRS credit a lot because simply they are not effectively run, in my opinion. However, in that case, they really, you hit them in the pocketbook. they did a lot of things.
Figure it out.
Yep,
Yeah.
they did a lot of things. And some of them they did very well. Some of them, yeah, but a couple of them they did really well to help curb this. This is just one of those small pieces to try and force these unusual credits. You might call it a negative tax, people getting a refund where they didn't have tax paid in, or more of a refund than what they paid in. So yeah, some of the stuff was implemented. This is one of the reasons of those delays. Yeah. Any others you can think of?
No, that was
Yeah,
the
it's a
one
great
I was
addition. All right. Well, I think that's going to wrap us up for today's episode. A little bit of a longer episode today. So as long as you're still listening, thanks for hanging out with us. As always, if you have questions, please submit them to us. We would love to hear your specific question, and we'll try to give you the best answer that we can. Other than that, I think we're out of here. So thanks for joining us on Questioning Your Sense with Kevin Mullen and Charles Steinmetz, and have a great day.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molintax.com.